Hello ladies and gentlemen, and welcome back. Before we start our normal content talking about stocks, commodities and cryptos, I just wanted to say a massive shout out to each and every one of you out there. We just surpassed 100,000 subscribers on YouTube, and when I first started this channel, I thought there's no way we can get to that number. Really, we only got there because of you. You shared it with your friends, family, and of course on the internet. You liked, commented, and subscribed, and everything else. So in today's video, we will be doing a little bit of a giveaway coming up, and I just want to say a massive thank you to each and every one of you. In regards to markets around the world, of course, all eyes continue to be on things like the SP500, the US stock market. We've got a coiling market. That means that it's trapped within two little ranges, and breakouts on either side could offer quite a lot of opportunity. So let's break down all the macro and of course everything else in the markets right now. I'll see you soon. This will be a really good one. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities and cryptos. If you like those markets, of course, consider subscribing and smash the like button if you enjoy our content and find value in it. Let's begin by discussing about the current macro data and what we've seen coming off the bottom of this current rally. Well, a lot of people think the bottom's in, and they could be right in certain sectors of the market. Remember, technology tends to bottom before the real stock market, that is the S&P 500, and often it can hold better than others if we truly have found the base. But if we're looking through history during recessionary periods anyway, markets tended to find lower lows. That is, they came down to price multiples much, much lower. Indeed, even in previous pullbacks in the S&P 500, we generally got to a price to earnings multiple of around 15 or under, and we haven't achieved that just quite yet in this current low that was formed on the markets. So of course that brings the question, is this a bull trap? Well, a lot of people have discussed it, but as we know, it takes time to suck in all of the people into a market rally like this. And that's why we've been bullish now for pretty much over a month in terms of price action. We just like to follow really the psychology of the market. What's the market telling us? We'll follow that. And in today's video, we will be discussing most of these things. Let's talk about bear markets and go back to 2007 and of course 2001. And what you'll notice is that there are similarities between some of those. In fact, there are similarities even with the rally. We overshot a little bit and now we're rallying back up. Interesting to see that there's a lot of turns that start to come through in August and September, and there are some seasonality reasons why that can occur. FANG revenue as well, just so you can see real growth here. First time pretty much forever that this has actually shown a negative. That's interesting to see. Will it continue? Of course, some people expect Q3 earnings to be really bad. Maybe the market's already priced that in. And a lot of people are also pointing towards the yield curve inversion. Obviously, this usually brings about what we call recession. They've changed the terms on what a technical recession is now, but the bond market is something to be looking at. Now, a lot of people have messaged me recently and they've said, Tom, what about that 3-month, 10-year bond? It's really concerning, it's coming down. Well, remember, it's the 3-month bond. So what that means, or yield. So as the Fed raises rates, it gets closer and closer and closer to the 10-year. Based on everything we see in the bond market right now, of course, we're going to invert on the 3-month, 10-year. I don't think this is new to the market, and anyone that's using this chart, I mean, you just have to look at the real numbers right now, and you would know that this will invert as the Federal Reserve pushes what's expected to be at least 3.2% as the cash rate by the end of 2022. So both of these together generally are the best recession kind of indicators. The longer they stay inverted, the more chance we have to go into a recession. And it's worthwhile noting, but again, it's not going to necessarily help you at this point in the market. We're already down a lot. And of course, most people are now talking about the turnaround. So how do we get to a bit of an idea of that? Well, a lot of people point towards this, that is freight. Of course, we had supply as the major issue that was really causing so much inflation. We've seen COVID, of course, cause all of these supply chain issues, mostly coming out of course, places like China, and demand went up due to stimulus created by the Fed and governments around the world. Well, now we've got effectively a lot of shipping container costs coming back down and going negative. So things are getting a little bit cheaper again. It's a sign that probably, yes, inflation has peaked. But remember this, there's a difference between inflation peaking and inflation getting its ass kicked. And that's what we want to see. We want to see inflation getting absolutely beaten down, back down to that 2-3%. So at the moment, the yield curve, that is interest rates in the world, is expected to go up, flatline, and potentially it may need to flatline longer than many economists expect to actually start to put a dent in this inflation story. So just remember, things are looking better, sure, but only in some ways. Another thing that no one's really talking about right now is midterm elections. That's the whole reason usually we expected 2022 to be so volatile. Midterm election years are horror shows really, and August, September, and October tend to be the worst months of the year. This is just a quick chart of the VIX. We've talked about it plenty of times. That is the volatility index, and volatility is expected to spike. If we have a look at here, Nasdaq's obviously rallies. Then we look at profit forecasts. They continue to be cut by most of the big kind of players out there. Does this mean new lows are coming? Well, certainly they're forecasting lower lows. I never really look at the forecasts too much. Usually an average of them may be worthwhile, but they are still expecting worse earnings in the future. And if we actually take out, let's say, the energy sector from the S&P 500, the EPS growth is almost zero at the moment in the S&P 500. So it's really just certain sectors that have even held it up. The rest of it is still sick and may continue to get worse. As we're in earnings season right now, we're still on a 67 beat rate percentage. Obviously beats 901, misses 444. Just remember with this number, we don't have very high expectations at the moment, or at least the street doesn't. So beating a bad number isn't hard, but what a great story to allow the market to go up. You know, it's always around these stories that helps us. We've now had some big earnings. Of course, AMD, PayPal have come out, SoFi, etc. And we move towards these other decent names for the end of the week. Some people will be looking at Baba, obviously AMC. I'm sure some people are still looking at that. DraftKings, Datadog, etc. So there's still a lot of businesses, but the biggest earnings were last week. So again, what are the catalysts to push us higher? You have to ask that. In terms of the last 24 hours in markets, how did it look? Well, if you were watching, if you're a member of our private community, you would have seen at the morning, we kind of talked about a key level. That level was also discussed here on the channel. And we talked about that kind of 40, 90, 40, 80 zone. So we actually moved down to it during the news that came out. And then we just rallied off that, almost creating a new high, getting right up to the peak and then selling off. And this came all the way back down to the same level. So it began kind of coiling that we're seeing in the markets right now, a resistance and a support, two really key levels to be looking at. It was a bit of a sell-off into the end of the day though, and this meant that certain sectors were doing better than others. We didn't really see too many standouts. It was still a day for hyper stocks. So things like clean energy did well and solar did well, that's TAN. Other than that, it was just really gold, real estate REITs, and metals that were down on the session. So they did a little bit poorly. Let's move over to the VIX. Volatility did spike due to, I guess you would say, the Pelosi plane trip. That was an interesting one. Everyone was freaking out about it. I think it's better just to always say, ask yourself this critical question whenever it comes to news. If you were trading and if you were following the direction and following your trade system, would the news have positively impacted your trade or negatively impacted your trade? If you can honestly answer with yourself, generally it's going to be better if you just left it in, then why do you worry about all of these news? There's always news articles, there's always things. Most of them you forget about in a day or 2 days' time. There are very few that are critical that then last over a very long period. So just remember that, and of course practice your risk management. The VIX here is a long leg doji, so it could continue to fall down. We've hit the 24 again. If the market rallies, the VIX will go down. If the market dumps through this current support level we'll look at later, then of course we'd expect the VIX to rally. And a lot of you, I've noticed, have placed kind of bets around this zone towards rallies. I think a lot of it's based on seasonality, that is August, September, and October being poor. Yeah, certainly there is merit to that. Another reason why a few of you have been this chart here, which has been the S&P 500 above the 50-day moving average. And as we noticed, if we go through part of the old times, November 21, January, just before the big crash, and then of course April, similar to last time when we saw that big fall off, we got to a lot of stocks above their 50-day moving average, and then we started to kind of dip over or at least consolidate. Where are we doing the same thing again? Well, that led into, of course, a big drop off in stocks. So we need to be aware at this stage, maybe this biggest part of the bull rally is currently over and now we need to consolidate for a little while. US 10-year bounce back. So we saw a big violent bounce back in the yield, basically 2.714 comes back to the previous support level, which becomes resistance. We'll talk more about this when we go into the US dollar. And in fact, we'll do that now. So here's the trend line from the US dollar, and it bounced off this level. So this is an interesting point because, of course, we know that there's a 20 moving average weekly sitting around here. We also know that we went into distribution, broke through, and last week we discussed this sell-off that was going to happen in the US dollar. The bounce was pretty significant, so now it pays really to go and have a look at this smaller time frames. So at this stage, we're still making a series of lower highs. We still have a lower high here on the US dollar. It looks like it's probably going to sell off a little bit here, but you've got to be careful of the switch. If the switch happens, you could see US dollar really pump up. And at the same time, the only reason the dollar is going to go up is the stock market most likely will be going down. So watch very carefully where the stock market is trading. That is the SP 500. If it breaks through and you start seeing US dollar go up, well, of course, that's a move to cash safe haven. We don't know that's going to happen yet. At this stage, it's at kind of like a technical resistance. So you could expect something like this, or you could even expect the fallback and of course get a new low while we're moving much lower here on the dollar. At that point, there's not much holding it before that weekly 20 moving average. So there's quite a lot of good little trades potentially in here. You could play it both ways, and it's just about getting the trigger correct. And of course, you need to dial into the smallest timeframes for that. This also led to a great take profit in gold. Congratulations, anyone that took gold recently. I know there's a few out there that have had this one on their own charts and they've taken it. This was a big level. I mean, we discussed this at quite a lot of detail. What a zone, smashes straight into it. Shooting star candle straight off that. That's a rejection candle for anyone that doesn't know. And it just went bang straight down. Yeah, that's a super level. So congrats. I'm still not bearish on gold overall, but I do think that there's a real chance here that we move down to some of these key box zones. And for anyone that's just listening to the audio, we're talking about kind of like that 1720 zone, 1730, and around 1750. All of those areas are basically zones where you would be hoping that buyers show commitment back into the trade. At this point, we don't know where it's going to be. Of course, the take profit from the initial move is certainly done. And now it just goes on to, do we see the flow coming in? And as I promised, I will update you guys here on the channel if we see large flows coming back into gold officially. At this stage, we don't have the official numbers. We'll find out soon. Let's move over to actually just the Euro US dollar before we go into oil. And on the Euro US dollar, you'll notice it broke through this trend line and it had that little false breakout on the upside. So this is what you've sometimes got to be a little bit careful with. This would have triggered so many buys in, and all of a sudden it's come down, 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 traps itself. There were a couple of smaller trend lines. So there was a little trend line that was formed through these last lows. And I think that was probably the one that really showed the best capability of potentially getting in the short if you were willing to do so. You've got a peak, a trough, a higher peak, you end up breaching that and it just goes bang straight down. There's probably some recovery here up until this trend line or even 1.024, which will be in line with the DXY, but these are all scalps at this stage. We don't have a clear direction just yet. We need to see again with that US dollar whether it rejects that zone and it's prepared to go back down. And then of course the euro would be the counter trade to that. Let's move over to US oil. Oh, I tell you, it looks weak, but at the same time, we just haven't, I don't know if you want to trade this level. You know, this is the kind of support becomes, you know, potential demand level. We've still got a series of lower peaks. So if I was guessing, I would still say down for oil at this stage. If the US 10-year drops as well, that's a very good coinciding factor with dumping oil. Future contracts are sitting quite a lot lower. They're sitting around that kind of 85 level later on this year. So again, oil is projected in many ways to go lower. It's got a long leg doji showing indecision. And at this stage, if you're looking at the smaller price action, like say a 1 hour or even less, you can kind of see how each time it breaks through, it just gets hit down very quickly. So if it makes a new low here, there's a good chance that it will put pressure on. And of course, alerts should be set really more for prices underneath around that 92 kind of 65 level. At that point, I wouldn't be surprised to see a really large fall in things like oil. Copper's kind of similar. It's weakening. We showed this on the charts, and copper is showing some turnaround signs to the downside. It hit our first take profit, which was over here, that 3.55, formed off all of these levels. It reached it perfectly, and then we've seen reduction in copper. And this again just shows that there's a bit less demand, and that's a sign of really demand destruction by the Fed in these markets. So quite a lot of things going on here. We've seen copper kind of retest, a new low formed on copper. Probably pushes it quite a lot lower. We move down to maybe a 3.35 there. And if you're trading, let's say anything to do with iron or steel or aluminium or anything, this, or aluminum, as many Americans will call it, this is the one. So you always want to be looking at copper to give you a good line of in the sand of what the metals are going to be doing next. 3.55 will get the bulls back in. At this stage, it's still looking bearish on the smaller time frames. And it hit that zone, which was fantastic. Tesla rejected again, so we got that first rejection. We got a little bit extra rejection. Some people will be looking at the low here on Tesla on the small time frames. Again, let's just load up a 15-minute chart here and go on down. And you'll notice that we have a low that's about 880. Funnily how that's a solid number. The eights, yeah, the lucky eights. So 880 is the support or the demand zone. We've come up, we've broken down. At this stage, we're still obviously in the bull trend, but we can see that rejection has happened. Then there's been a kind of secondary small rejection that's come off a little bit lower. If the stock market fails and the Nasdaq fails at this coil zone, you probably expect suddenly Tesla to go down and maybe move towards much lower levels. So look towards things like this 845 at that point, or even further down. We'll discuss that very soon. Apple, again, weakness here. You can see the support sitting around just under that 160 zone. It's a gap that could be filled easily. This will be in line with what we talk about on the SP 500 very soon. So we'll discuss that very soon, both ways to the resistance and the support. And in general, things like risk on seem to be kind of playing out at this stage. I would say that there's no strength here in XLY at the moment. The last couple of days have been middling. That means that there's a kind of equal amount of growth and defensive plays being playing out in this market. So not much to say from here, but this is consumer discretionary versus staples. And remember, you use that to get a bit of an idea of the American consumer, which is around a third of the US economy. So it's a very important point. For all the Australians out there, I thought I'd give you a bit of love, guys. The ASX 200, this is the ASX or the top 200 stocks in Australia. Obviously a key point here of potential turnaround. We have all these previous supports. We broke to the low. We've rallied to this zone. We did a couple of sessions talking about this when it was down here. And now that we're at this point, it's kind of like coinciding with a lot of stuff on the S&P 500, as it often does. So you're looking towards potential weakness here. Again, small time frames, look towards the turnaround story, and usually you'll expect something like this to occur. And if that does happen, similar to this kind of thing here, then it can really show that the weakness is in. So be careful at this zone, guys. This is where the bears, if they're going to come back, really hit up this market. DAX still holding its best above the zone, keeps finding buyers right around here. That price is around 13,333. If it makes a new low underneath that, this rally is probably gone, and you could see it go all the way back down to here, which is about that 13,080 area. So yeah, still bullish in terms of smaller time frames, but just holding on at this point. IWM, not much to really state here. The small cap Russell 2000, it's not showing us too much, so we'll skip over that. And we'll move on to some of the big ones. Here's the Nasdaq. So let's take a look at the Nasdaq from a trend down and a trend up in terms of, movements and legs. So if we took actually the peak, which is over here, and we go all the way down to the trough, and we actually then extrapolate that out again, you'll find they're actually very, very, very similar in terms of length. Now, when you have these types of moves that are very similar, you can then go back and have a look at the pullbacks and see whether they're similar as well. And you'll notice that right around here is very close to the same pullback we got back in March into April. Obviously not quite the ferocity of that move. That was clearly more, I guess you would say, bull trappy in terms of how fast and ferocious the move was. But we've almost hit so many similar things. We've got the downward trend line, of course. If we go a little bit higher first, we've got the previous supports becoming resistance. We've got the same move. We've got the Fibonacci, all sorts of things coinciding with each other. So when you break down something like the Nasdaq at current levels, it makes sense that we could be coiling here for that final move up as well. So what are you going to do? Well, the best thing to do as a trader or an investor or anything is really to look at the key levels and to recognize the risk versus reward. So we kind of have that 13,084 as the top. We've got somewhere around this 12,800 as the bottom, as the low. And we know that if it breaks through, our kind of best case scenario at the moment is about 3%. Now, of course, the worst case is much worse than that, because this is 3% to get to some seriously critical levels across the board. So this becomes the thing where you say, well, maybe I should be fast and nimble. In fact, day trading and scalping may be the best course of action in a market like this, or using risk-adjusted, kind of trading systems. So we have a coiling market. We've got key level support, key level resistance. And in these cases, because I know the Nasdaq likes to do some fake outs, I think the best one to come to is the SP 500. So the level we talked about in the previous session, the 40, 80, 40, 90, held in the previous session. We'll look at that soon. But if we do move through to the downside, that is, we get past this coil and move through, where's the next level? Well, it seems to be that the next level is probably around 4,000, as you can see here, to like that 39.90 area, because previous resistance, previous support, and that's where the wicks came off. So somewhere around there is the key level. I also really want to point out that there are key level gaps that have been left behind. 1, 2, 3, and 4. These are 4 gap zones that have not been filled. So for people feeling FOMO out there, there's really a good chance, and that's a good chance. It doesn't mean that, it's going to happen, but it's a good chance that at least some of these gaps, some of these inefficiencies are filled sometime, hopefully either this year or next year. And I would guess this side of the year, at least for some of these. So if you're feeling, FOMO, really what you do is you just always come from the idea of abundance. And I've been talking about this a little bit, and a lot of people have been saying it helps them. If you miss a trade or you miss an investment, guess what? There's another one just around the corner. There's another one. There always is. Think about how many you've seen in 2022. Think about how many opportunities you've seen in 2021 and 2020 and every other year. There's always a lot of opportunity. So let's move over here to the futures market and we'll discuss some of the key levels. So we've got the wicks here. Notice it took that low last night and just went bang straight in. So we've got clear resistance and we've got clear support. For the buyers, it's really time to commit. If they're going to commit, that is the big algos and everything else, it really needs to buy off this zone. You've got to be very careful around here. This reminds me so much of what we saw just over here, where we had that, what we call the defended zone. And we defended it. It was great trading. Don't get me wrong, perfect, great trading. And we made a series of lower highs and then all of a sudden fell off. And once that defended zone was taken, let the floodgates begin in terms of down. It looks very similar to right now. So we have the defended area. For the buyers, they need to show commitment right here. If they don't show commitment and you don't have like your little turnaround stories, seems like we're getting a little bit of resistance here around that 4,100 zone at this stage. Then if we get those turnaround stories, we move up to the 4,140. I'm thinking that at this stage, some people may want to take profit fairly quickly here. If it breaks through, then where do we go? Well, there's a good chance we go to 41.76, the previous high formed over on the left-hand side during the previous high. And then if we go underneath here, what happens next? Notice the wicks here, back around 4,000. This level, if we breach through, pullback should be met by sell demand to get us down to that level. If we get through there in the future, the big one to have on the alerts is going to be around that 39.20, 39.10. This zone is huge. I think this is one of the biggest areas in the market moving forward, and certainly having alerts set around that 39.10, 39.20 is going to be worthwhile. So we've got some key areas. We've got a coiling market, which often shows indecision before a key breakout. Expect volatility moving forward, which is why some people may look at the VIX. I'm not sure. VIX is very expensive to hold, but some key levels, great zones, and of course, hopefully you can apply your systems to those areas. Let's talk about here what's going on with options. Well, let's bring it in with the options expiration. We've got here the Wednesday expiration, max pain 408. What's that mean? Well, it means that all things being equal, If the market closed at 408 at this stage, obviously it'll change through the day, that would be the best profit for Wall Street and for all the options makers. If we look here at the charts, you can see that they've got lots of puts sitting around 400. Interesting area. Notice we just discussed that. And then you've got a ton of calls and puts sitting around that 410. Interesting area. So in here, probably around that 408 actually, max pain is where the market may want to finish at this stage based on the information we have. Coming into the Friday expiration, we have a huge amount of calls. Notice where they are, 390. Interesting, they're sitting all at 390, that key zone, and 400 and 410. So there's a decent amount of calls coming in, not enough yet. You can see there's so many puts still sitting in this system. And that usually has been why we've been able to go up. We've been able to go up because there's too many bears. And when everyone's bearish, it's tough for the market to really go down. But of course, if coils are taken out, the options are confirming the zones that we're discussing on the charts. And that's important. That's something we like to look at. Quick rundown here of Bitcoin. Obviously, the rainbow chart still says it's technically in a fire sale. And that's only if you're looking at it for a very long period of time. And what I'm looking for this year is really more about the halving cycle. So more about a timing based on the halving cycle and based on height. I do believe Bitcoin is really trading with Nasdaq right now. So if Nasdaq weakens, expect Bitcoin to also weaken. There's a couple of hacks going around as well. I don't know if it's Solana, if that's official or something, but I heard something about that in the community. And it looks like kind of Bitcoin's at the previous resistance support level. So again, a break below here could really put pressure onto 22 quite easily, or maybe even 21,000. So be careful here. Mostly it's a trade in line with the Nasdaq. If you haven't already, come and follow us over at FX Evolution on Twitter. And I do want to also make a bit of an announcement here. We've got a giveaway of some of our courses. For all of our courses, we're giving away first, second, third, fourth prize. So if you're interested in getting involved, then you can do so. It's for the 100K giveaway. We'll do the live stream on Monday and announce it. And then, of course, contact whoever's won, the lucky people that are won, and we're giving away quite a few prizes, and that's just thanks to each and every one of you out there. I just want to give a little bit back to the community. So if you're interested, check it out. If not, that's all cool. Let's move over to the news moving forward. We have here the CPI number coming out for CHF, ISM manufacturing PMI, 10 a.m. New York time. That'll be a little bit of volatility, but the real market movement will most likely come with non-farm payrolls. Remember, that's happening on the Friday, 8:30 a.m., 1 hour before the New York Stock Exchange opens. And this is the jobs numbers, guys. So people will care about this. It's always sure to create fireworks. And remember, the initial reaction is often the wrong one when it comes to non-farms. Don't try to understand it. Just try to react to the after reaction. That is, try to figure it out and then move into it. For a scalper and day trader, you can get absolutely destroyed in this one. So be careful out there. If you've enjoyed the content, remember to subscribe, smash that like button, guys. And thanks to each and every one of you. Bye for now.